Hello, everyone. My name is Swarup Mohanty. I represent Mirae Asset Investment Managers in India and like to welcome all of you for this live chat with me on Facebook. These are very interesting times, very unprecedented, I must say. And so, on behalf of Mirae Asset, I'd like to thank all of you for joining in today. Of course, investing has become very different in the last 2 months, and the markets have had their own way of working. We've had a lot of queries, and we thought we'll do this one on SIP because when you look at the last 4 or 5 years, investing through SIP has become a reality. Just look at it. I mean, when you go back to just April 2016, the industry used to get a shade above 3,000 crores per month in SIP. And come today, that is the end of March, probably the March figures are not yet out, but if I were to give you the Feb figures were around 8,500 crores per month. So I can safely deduce that the Indian investors have really taken to investing through the SIP route in a very good way. It has given them participation in the market over a period of time. And we'd like to explain or discuss that a bit over the next 15-20 minutes. When you look at investing in markets and especially the capital markets, volatility is nothing new. I remember I was a student or I was just about to start working when the first big scam that hit the market, which made the markets very volatile, was the Harshad Mehta scam, which was, I think, in the year 92, 93. Then I'd started working, and subsequently the huge dot-com boom and the dot-com bust, which I saw in the year 2000, was also a huge learning for me. I think the dot-com period gave me a lot of insights into uh, risks and how risks can unfold in the market, something which we are seeing just about now. In 1997, also we had seen the Great Asian crisis, and then of course who can forget the 2008 financial meltdown globally. So when you look at all these 4 or 5 large incidents, it leads to a certain amount of a breakdown of markets, and that is what investing in markets are, and they are susceptible to external factors, and such factors really come out and affect us on a daily basis. It's just not markets which have affected us. Let's face it, life around us has changed, and in that changing scenario, let's look at how we should approach SIPs, or how we should go about doing things. Because when such an external impact happens, it is natural that some amount of our decision making changes, right? People in the past, and let's look at, just go back as near as 2008, 2009, when the markets had corrected severely, and the investor behavior had changed dramatically. Then I just talk about that one phase, because when we looked at that one phase, there was a fair amount of panic which has set in, which is understandable. When you see money going down or the NAV is going down to this level, it is fair that some amount of panic sets in. But in that panic, what happens is people sometimes stop their SIPs. In 2009-10, I remember almost 60% of the industry SIPs had stopped. Some amount, when you stop an SIP, obviously you get out of a financial path which you were on, and that path sort of gets derailed. That's something which one has to realize. And of course, when everybody starts thinking in a certain way, we then call it a herd mentality, and there's a fair amount of herd mentality kind of behavior which sets in. The conclusion that happened last time around, was that when you look at the markets, and when you look at what history has told us, that in the short run the equity markets or the capital markets behave very irrationally, but when one elongates the time frame, and a lot of rational behavior in the markets set in. But at times like this, it is very pertinent to go back a little, look at the broader side of the entire spectrum, and sit down and think a bit, because the markets will behave the way they are set to behave. The volatility is there, and it's there around us. The only thing that is in control that we have is our own behavior. And in irrational times, the more rational that one becomes, the better the investment experience that unfolds. And that's That's the message which had come out in 2008, 2009, because investors who stayed put by the end of 2012-13 had not only recovered all their gains but had almost doubled their money in that phase. And that is what is playing out this time when you look at average investor behavior of thanks to the growing advisory climate around us. Most distributors, most advisors, and including investors are seeing that learning. And today I'm so happy and I'm so glad to say that the industry SIPs, including the ones with Mirae Asset, are staying put and they're continuing the journey. And that is probably some things which are so good to see. Not only are we seeing that, we are envisaging that the investor today is far more mature, has learned enough from those incidents. Because when you look at the past and you go a little bit deeper into those figures, and let me talk a little bit of figures from that perspective. When you look at it from a longer term perspective, and we've discussed some of the events that are unfolded over a periodic which includes both the bear phase as well as the bull phase. If I were to put a long term sort of graph over the last 15 years, the BSE Sensex has returned 14% annualized return during the last 15 years, and that's not a mean sort of return. And that's what I said, that when you elongate this period over a longer term, things sort of change. And that's the beauty of capital markets, which is unfolding. So SIPs seek to ensure protection from a volatile market, and that's something which is pretty evident over a period of time. And I'll give you some examples of that as we speak. One of the biggest blunders, or one of the mistakes that had happened in 2008, 2009 was people had discontinued their SIPs. And when the markets start falling, it is but natural that some of us go into that thought process. But investors can somehow today take some comfort from that data. And I'll give you some basic data to leave you in your mind to think about it. Over the long term, if you see, SIPs have outshone or outdone lump sum investments, as investors were able to accumulate uh, more units during the downturn. What is very interesting is that when markets fall, your money term suddenly converts to units, and that's something which all of us have to keep in mind. And it is due to this increase in units that the average cost per unit ultimately becomes lower, and that helps in long-term wealth creation. Between January 2008 and March 2020 is a fairly long time, which has seen two sort of severe crises, and it's very interesting to see, because we believe that 2008 was probably one of the worst hits in the market, and what has happened in the last 3 months is almost equal, not yet there, but it's pretty severe. And when you put those two in perspective and look at some data, let me give you some data. Is that when we had a bull phase between April 2003 and December 2007, the SIP returns during that period for an amount of, say, we've considered the SIP of, say, 1,000 rupees versus lump sum of that same amount in the S&P BSE Sensex for this analysis. And then when I give you some data from that period, is that in that bull phase, the SIP returns were 47%, and the lump sum returns were 49%. Then during the subprime, which is January 2008 to, say, March 2009, those returns plummeted to 36% negative in the SIP side, while on the lump sum, it was 45% negative. The SIPs had sort of absorbed the shocks because you were buying across the fall, and the fall in the SIP returns were far lesser than that of the lump sum. During the global trade war times, which is, say, between Jan 2018 and February 2020, the SIP returns were 3%. At that point of time, the lump sum had sort of outshone and had given investors 6%. And when you look at a period from Jan 2008 to March 2020, and please understand, these are two large events which have happened in this period. The SIP returns today stand at 7%, while the lump sum investment stood at 3%. So clearly, participating in the market in the entire downturn has its own positives, and that's something which we cannot sort of wish away, and some things which we should learn from. because the SIP returns are XIRR while when I look at these data, while lump sum is an absolute investment period from that period to this. So there is a little bit of difference in the two, and one should keep that in mind. When you look at benefits of SIP, you cannot really do away with some of the gains that happen when you participate in the market periodically. We are all probably witnessing one of the best phases of rupee cost averaging at this time. I mean, let's look at it. Some of the NAVs which have come down from 50 to say 35, 36, you are now accumulating units at this rate when just 2 months ago the accumulation of NAVs were far lesser than what it is now. And on the upturn of the market, one benefits by accumulating units at this period. If you ask me personally, I would really hope that this period is a little more elongated so that on my personal SIPs, I can start accumulating more and more units. That's what rupee cost averaging does to us. The SIPs then allow you to participate as a smaller size also. You can participate in 1,000 rupees, which is so good over a period of time you accumulate is. Of course, I personally, when I look back at my career, I wish I had started my SIPs when I started in 97, 98. But unfortunately, some of the SIPs which I started very early on were of very low ticket sizes. I wish I had done higher ticket sizes then, where the results would have been pretty phenomenal today. So, though the benefit of investing in low amounts are there, but you should look at as much as you can, and that's a personal sort of suggestion. One, the best part about SIP is it completely avoids market timing. It continues to participate in the market at certain dates in a very unemotional way, and that's something, one of the best parts about SIP, because you really don't know how markets would behave. I mean, look at some of the commentaries which came out, or practically all the commentaries which came out in December last year or January last year, and look at the same commentary today. Nobody sort of envisaged this. And then when you look at the overall story, and somebody would tell me that, here is a virus which is ruling the world, there are police on the road, and you are stuck into a house, it's like a movie story. But when such a thing happens, it's no prediction that works, and no prediction can possibly work. But in that same period, if I look at my personal SIPs, they are unemotionally hitting the market, getting the participation that I would, left to me personally, would have thought twice or thought three, four times before participating. But that's the beauty of an SIP. It sort of avoids market timing and goes on participating in a seamless manner. The best form, and I think something some of us should reflect on that, or the best way to achieve goals is also through SIP. If you fix, we always say this as a fund house, that when you think of investing, the best way of investing is through when you know where you want to invest, or you know where you want to go. If you don't have a purpose of investing, then your path of investing becomes very wayward, or it does not have a path. So the best way to invest, we feel, is through a goal. And if you fix a goal, then reaching that goal through an SIP is also a very, very tried and tested manner. And I would really encourage all of you to try our goal SIP. We have a very good goal SIP process laid out for you. You can come and check it out on our website too, how it works, and it really is puts a lot of science into investing, and takes you to your desired goal. And there's no bigger kick in life than to hit your goal and redeem that money and go and enjoy your goal. And that's something which SIP investing can do. When you look at a broad way of goal SIP, and I'd like to elaborate a little bit more on that, a good way to not sell SIPs during market downturns like this is to map those with your financial goals. This will help investors, or all of you, to stay focused and keep the emotional basis under control. Please understand, the lesser you become emotional, the better the investing experience become. you know uh, uh, it becomes mathematics at this moment of time, how much money is going in, how many units you are getting out. And somehow, when you put it over a longer period of time, you will realize the larger amount of units you accumulate, the chances of making money on the upturn are brighter than lower amount of units. It's just pure mathematics. So when you elaborate on SIPs, let me give a very simple example. Let me take, say, just for example, say three gentlemen, Ajay, say Samir, and Vikas. They had started investing 1,000 rupees in an SIP in the S&P BSE Sensex from April, say, 1997. Their approach to market volatility would be different. And let's look at three different ways of investing. Okay. Ajay would invest 1,000 continuously during several bear phases. He is a persistent SIP investor. He just goes about investing. Say Samir, what he does is every time the market falls below 15%, say something like what's happening around us, he increases his amount to 2,000 rupees for the next 1 year. I mean, he believes that these are good times, so instead of putting 1,000 rupees, he invests 2,000 rupees. And there's Vikas, who every time the market sort of falls like this, he stops his SIP for a year. He believes these are not times to invest. And I'm giving you three different perspective. One who just continues the SIP irrespective of what happens in the market. One who is slightly risk perceptive and increases the SIP by doubling it during market falls. And one who completely stays away from such falls and says, no, I will not participate in this market, and puts his SIP to stop for that 1 year. When you look at the end and you look at Feb 2020, the same data, Ajay would have invested 2.75 lakhs because he's participated in the entire market. Samir, because he's increased his SIP time and again, his participation would have gone up to 3.15 lakhs. And Vikas, because he stayed away from the market time and again during such falls, would have invested 2.35 lakhs. The units allotted or accumulated due to the different three processes, Ajay would have accumulated, say, 35 units, Samir would have accumulated around 42, and Vikas would have accumulated 28. The total amount for the three in the three different sort of approaches would be Ajay would have gained, or his amount of 2.7 lakhs today would be 13.24 lakhs as we stand, or 30. Samir would have gone up to 15.93, and Vikas would have done only 10.54 lakhs. That's how this would have played out. Obviously, somebody who benefits from the downturn and looks at them as opportunities over this period of time would have benefited more, is something which is coming out from this story. And this is data, and data typically does not lie. So the lesson that we learn from this is volatility is there in the market, especially for an SIP investor. Volatility is a friend. Please remember that. I will go one step ahead and say, for an SIP investor, volatility is his best friend, because at these times that the real value of your SIP comes into play. You start getting money, you get worth for your money in the form of units, and over a period of time it plays out. Vikas would have missed out accumulating more units, as is quite evident, because compared to Samir, he's just been a steady approacher. He's just participated. Hence, the gains of his corpus, though he has been good, but he's missed out some bullish phases. And in the case of Ajay, that is between, I was talking about Ajay versus Samir. While Vikas staying out of the entire fall phases, he wouldn't have earned as much. And that's something which all of us need to reflect. When it comes to times like this, I'm always reminded of a quote by Lenin. He would say that there are decades when nothing happened, and there are weeks when decades happen. Think about it. I mean, when you look at lives in the last 2.5 months, everything has changed. And the way we had approached life and the way we are approaching life now is completely overturned. I mean, who would have thought that we would be sitting in our houses and talking to each other or through a laptop or a video camera? That is how it is. But when you look at the external market, and when I talk about the market, I look at the equity markets at this moment. When we build portfolios, we aspire to build portfolio on a certain parameter, and the parameter is to build or buy good businesses at good prices. Just 2 3 months ago, some of these good businesses we thought were not good prices, but today the prices that are in front of us are pretty. I mean, what can I say? The right term would be fairly valued at this moment. And one, there are two ways of looking at it. One is to participate and get the benefit of this value. That is what an SIP would do. Or you can sit and watch and wait for things to sort of come back to normalcy and then take corrective action. Finally, your money or your own way of looking at it. But somebody who takes benefit of these values at this moment would stand to gain over a period of time. Please understand, this is a medical sort of crisis, and over a period of time, a medical crisis typically has a start date, also has an end date. Next time there is COVID-19, it won't be a crisis, it will be an illness. There would be some medical solution for that, and then life would go on. Next time there is COVID-19, trust me, the world would have upgraded, and it won't see the volatility that we are seeing now. Maybe something else will come, and that's why we say every crisis is very unique, and one should not compare one crisis with the other. But the fact is, every crisis has a start date and an end date, and the world graduates within that crisis in a very different form. I'm pretty sure that when we talk at the end of this crisis, a lot of sanity would have prevailed. And when sanity prevails, trust me, a lot of things come back to normalcy. Maybe it'll take some time because the virus at this moment is dictating terms. It's just a matter of time that some scientist somewhere will find a cure for this virus. And when that happens, a lot changes back, and the markets will not wait then. And so the time between uh, 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 the opportunity is between now and then. It's the way one looks at it. But I would say that investors should also, at intervals, undertake due diligence. Investors should regularly track their and monitor their portfolios. Of course, look at their own risk profile when you invest, and rebalance that portfolio time and again to stay on course. Please understand that there is a purpose to investing. There is a reason you invest. I'll conclude by saying that typically there is a risk to investing, there is a risk to not investing as well. There is a risk to investing in equity, there is a risk to not investing in equity as well. There is nothing called risk free investing. It's up to you to assess your risk and then marry that risk to the underlying investment. If that is done, investing is always a great experience. But at these times, it is most important to remain rational. It is most important to save yourself, be healthy. First, keep yourself healthy, and then think about investments. I'd like to thank you for listening to me. And if there are any questions, I'm open to take them. So there are some questions which have come about. This is from Mr. Abhijit. He says, my question is why Mirae Asset does not have an app yet. When can we expect? Okay, this is not related to SIP, but our approach to the whole process, digital space was through our website. We had our website is mobile friendly, so we thought there is we had expected the chatbots to take over, and which they are beginning to take over. We had expected that the when the bots start playing, they become interactive, and hence we would like to take the bot route over the chat box route, so app route. So that was our plan. Maybe this digital change in the market, after this is over, we need to sit back again and revisit all our the digital space in entirety. So once this is over, maybe Mr. Abhijit, I'll come back and answer this. There's another question which says, can we have a business model which allows increasing the SIP amount as and when the investor wants? Yes, I think the step-up SIPs are there for you, and that's a tool available across the market. You can very much take that up. and I think the tool is already there in the market. You can benefit from that, and I'm so happy that you asked this question. These are great times to step up your SIPs, and it's good time to really think the way you are thinking. I'm so happy you asked that question. The second question was from Mr. Saptarshi Das. He asked, can you please provide options of lump sum investing in emerging blue chip? Okay, it's a question which we get asked very often. Present situation is attractive to purchase more, NAV is less. I agree with you, Saptarshi. This fund, we closed the fund for lump sum in October 2016, if I remember correctly. Though the fund might look close to you, but the fund has a very healthy SIP book. It is accumulating, or the amount of money which comes into the fund through SIP is pretty decent. Hence, we like to keep it that way at this moment. Please understand, your money in the form of SIP is actually accumulating more units at this moment. And my humble request is to watch the fund that way, keep the SIPs going, and we at this moment are not looking at opening the fund. But I'd like to really thank you for that question, because yes, that fund has behaved in a very sane manner over the last 9 years of its there. But at this moment, we are not opening the fund. Mr. Rakesh Padi is asking whether the same question, Mirae Asset Emerging Blue Chip Fund redemption, or should I continue? I think that's not a question which I can answer. I'd really request you to talk to your advisor. I feel redemptions can happen if goals are met. If your goal is met, or whatever your thought of has happened in that fund, then you should redeem. Otherwise, I think it's a decision which you should take with your advisor, is my humble request. Which fund would you recommend to invest is a question. It's an open-ended question. Again, see, when I did talk about goal investing, so the way it works, normally the way it works, the process of investing is very simple. First, you find a purpose to investing. That is, you fix a goal. You talk to your advisor and fix up that goal, because between you and your advisor, there's a cash flow which is involved. And first, between you and the advisor, you decide whether that goal is feasible or not. Once that feasibility is set out, then you go about and build a good financial plan to achieve that goal. And everybody's goal is different. Once that financial path is built on a certain asset allocation, does the selection of fund come into play? The selection of fund it comes at the end. First these processes are met. You talk to your advisor, you fix a good goal, then according to your goal you fix a financial plan, and after that financial plan there is a certain asset allocation which happens, and based on that asset allocation you decide whether a certain fund is good for your portfolio or not. So again, we have 6 funds on the equity side, and around 4 on the debt side to suit various risk profiles. First, you set up those risk profiles and then come and check our performance if you feel some of them are suitable for you. If you ask me, I'm a biased person, I'll tell you all of them are suitable. So don't listen to me. Talk to your advisor and follow the plan. That's something which I'd like to leave behind. The other question is, why is Mirae Asset promoting SIP through debt funds? See, SIP is a concept. It's got nothing to do with debt or equity. Like I said, if you fix a goal and your goal says that you need 6% return or 5% return, why do you need to invest in equity? The biggest investment process in this country still remains the RD, or the recurring deposit in the bank, which is an investing on the debt side. So why shouldn't we promote investing on the debt side? In fact, the debt side of investing in through SIP is a very fulfilling method, and I would really encourage people to look at our debt funds, or debt funds in the market for that matter, to fulfill some of your goals at a fairly lower risk profile than the equity funds. the risk profiles of the two sides are very different, and one can benefit by some of the lower risk profiles which some of the debt funds provide to you, and achieve goals through them. Why not? I mean, we should be actually doing more SIP in debt when you compare it to the amount of recurring deposit that happens in the market in various banks. I'm still wondering why people don't look at SIPs in debt as much as they should have. I think there are a lot of questions. So there is one from Mr. Govind Vijay Singh. He is asking about a pharma sector performing fund. I think we have a healthcare fund, and we building track record there. We do believe that for that matter, any country, not just India, any country, the biggest pillars of those countries are healthcare. And at this moment, when you see the need for healthcare around us, it just brings to the fore that the healthcare, your consumption, and the banking are three big pillars on which any country is based on. So for us, when we launched the fund, we believed in the long-term prospects of the healthcare fund. Yes, one should look at investing in such funds, but again, I bring to you the aspect of sticking to a certain amount of allocation in those funds. When you look at the overall pie, you have to fix a certain amount that can be invested in thematic funds over the core funds. The core funds would be the large cap or the multi cap or the mid cap funds, and then come the investing into these thematic funds. So fix your asset allocation accordingly and don't over allocate typically anywhere, because asset allocation actually creates wealth. Over allocation destroys a lot of wealth. So be careful of that. Another question is from Mr. Saurav Jain. Would you recommend me to continue my SI small caps or shift to pharma pack? I don't recommend shifting of funds at this moment. There is a reason you should have invested, and there should be something in your mind before you chose the small cap fund. Though we don't have a small cap fund, but for that matter, any fund. Okay, these are good times for any fund to be accumulating, and those funds would be accumulating great units at this level. So at this moment, please don't change portfolios. It is what I wouldn't change it in my portfolio at all. I stick to the funds at this moment. And why should I change? All my funds, all my SIPs and funds are accumulating units at prices which were 30% more just 2 months ago. So at this moment, I'm a very happy SIP investor. Uh, uh,